Hi everybody. Thought I'd put together a short presentation on stock valuation and cost of capital. There are a couple of methods that we use to employ to value the stock of companies. They fall under two categories. One is dividend discount models, and the second is a method of comparables. You should know that there's multiple terms for each of these. Currently, analysts use something called free cash flow models as a substitute for dividend discount models, but we're going to start with dividend discount models and you'll see how it plays out from there. We're going to go through examples of each of these, but to give you sort of a summary, the idea for dividend discount models is to forecast the cash flows. So pretend like you're a shareholder. What do you get from investing in a company? Well, it pays you cash. It might pay you a certain amount a year from today. That's dividend 1, 2 years from today, 3 years from today, 4 years from today, and so on. And you want to find out what the value is that you should pay today. And so what you do is you find the present value of the future cash flow stream. That's what dividend discount models do. The second major method that is used to value the equity of different companies is called the method of comparables or multiples. In that you use industry or peer information to extract value or to extract the value of what you think your company is worth. So that's what we're going to do during this presentation, at least for the equity valuation part. So let's go through a bunch of examples. Let's take the utility or energy company, Southern Company. They pay an annual dividend of $2.03. By the way, we're going to go over 3 different examples. Case 1 is when the dividend is not expected to grow at any point in time in the future. So in this case, if you draw a timeline, the dividend in year 1, 203, year 2, 203, and so on forever. Investors that buy stock in Southern Company expect a rate of return of 7% per year. That's just an assumption. We'll take a look at that later on. Can we use a dividend discount model to value the company? Sure. We use something called present value of a perpetuity. And that's simply the value of something today is equal to the cash flow that you get each year in perpetuity divided by whatever discount rate is being applied to that. So in this case, cash flow per year is $2.03. Discount rate is 7%. So when we work that through, we get an estimate of what we think the value is for Southern Company stock of $29. $2.03 divided by 7%. Now, Southern Company stock is currently trading for over $40 a share. They are paying a dividend annually of $2.03. So something else is going on. Either the dividend is expected to grow in the future, or our required rate of return that we're using is off, or maybe the current price tag for Southern Company stock is a little high. Regardless, if we are not expecting the dividend to grow going forward, then we would value Southern Company stock at about $29. Case 2. In this instance, you use, in the instance of where you think the dividend is going to grow at a constant rate in the future, you would employ the constant growth rate formula. So remember in the previous page, the value of something today was the cash flow divided by the discount rate. That's if there's no growth. If there's growth to be expected, then you take the cash flow forecasted in 1 year divided by the discount rate minus the growth rate in the denominator. So in this case, we have an annual dividend of $2.03, and that's, again, the dividend today in year 0. We have a growth rate of 2% per year, and we have a discount rate of 7%. So that's what we need to plug into our model. $2.03 is today's dividend, so next year's is going to be a little bit higher. It's going to grow at 2%. It's going to be about $2.07. Divide by 7% minus the growth rate of 2%. Notice that both of those are in decimal format. So in this case, the dividend expected next year, so that's the numerator, would be about $2.07. Divide by 0.05 gets us to an estimate of $41.41. So that's our revised estimate for the value of Southern Company stock today. If we think that the dividend is going to grow at 2% per year, then we would assign a value of about $41 to Southern Company's stock. So notice we've now done two methods. Case 1 is useful in the instance where you don't think dividends are going to grow at all. Case 2 is useful in the instance where you think that there's going to be a constant rate of growth. And the third case is useful in the instance where there's a non-constant growth rate in either cash flows or dividends. So in this case, we have the same starting dividend of $2.03. It's expected to grow by 5% for 2 years, then 2% beyond. Same required rate of return or discount rate. So in this case, we have a little bit more work to do. We have a $2.03 dividend today, and that dividend is expected to grow by 5% for 2 years, and then 2% each year beyond. So in this case, we can't use purely either of the two methods. We have to figure out another way of solving this. The first thing that you need to notice is that a non-constant growth period occurs for the first couple of years, and then year 3 and beyond is the constant growth period. So we can actually employ the constant growth formula for year 3 and beyond. So if we take a look and forecast the dividends, what is the expected dividend in year 1? Well, we know that it's going to be $2.03, and we're going to add 5% to that. So $2.03 times 1.05 gives me $2.13. And that dividend is expected to grow by another 5% during the second year, bringing it to $2.24. And in year 3, we know that the growth is going to taper down to 2%. So the dividend that we would expect in year 3 is $2.24 plus 2%, so about $2.28, call it 2.24. Yeah, about $2.28. So, and again, it's going to grow at 2% per year beyond that. So during this period of year 3 and beyond, we're actually in a constant growth stage. If we're in a constant growth stage, we can employ the constant growth formula. We remember what that is. It says the price of something today is equal to the dividend in year 1 divided by R minus G. Well, we're not starting in year 1. We're actually starting in year 3 in this case. That's the first year of the constant growth portion of this. So when we invoke this formula, we're not going to get the value of the stock today. We're actually going to get the value of the stock in year 2. So 1 year prior. Again, P0 is 1 over R minus G. So if we plug in the year 1 dividend, the formula will spit out a value for year 0. Thus, if we plug in the year 3 dividend, the formula will spit out the value of the stock in year 2. That's also called the stock's terminal value. So if we take the year 3 dividend, divide by 0.07 minus 0.02, we end up with the terminal value of Southern Company of 2.28 divided by 0.05 gives us $45.60. So again, that's the value that we would expect Southern Company to be selling for at year 2. So if you're an investor, let's look and see what you have. You're going to buy Southern Company stock today. It's going to throw off a dividend to you of $2.13 in year 1, $2.24 in year 2, and if you sold it in year 2, it would be worth, roughly speaking, $45.60. Now, if you don't sell it in year 2, then you're going to get the dividends beyond that, but they're worth $45.60 in year 2. So we've now sort of encapsulated the problem into a solvable format that all we have to do now is find the present value of $2.13 by bringing it back 1 year at a discount rate of 7%. And then we have 2 things that we're going to be receiving in year 2. We're going to be receiving a $2.24 dividend, and then we will have a stock that's worth about $45.60 after that. So the total value that Southern Company will exhibit in year 2 is $47.84. So we have to find the value of that today. Of course, we're going to be pulling that back in time 2 years at 7%. So we're finding the value of each of the future cash flows that we're expected to get. So the first dividend, when we pull it back 1 year at 7%, we find that it's worth $1.99 to us today. And the $47.84, pulling it back 2 years at 7%, that would be worth $41.79 to us today. So the punchline, folks, is that if you found the value in today's dollars of all the cash flows that Southern Company is expected to throw off going forward, then you would assign a value to that today of the sum of $1.99 plus 41.79, which gets us to $43.79 total. So that is what we would value Southern Company's stock at if we assumed a growth rate of 5% for the next 2 years and 2% beyond. And that's about what Southern Company stock is selling for. Getting those estimates is a challenge. It takes a lot of work, but I've provided them for us today so that we can come up with this example. You can see it's a 3-step process. Step 1 is to forecast the dividends. Step 2 is to discount the dividends. And step 3 is to add everything up. But it takes a little bit of practice. So those are 3 different instances of dividend discount models: no growth, constant growth, and non-constant growth. In practice, analysts do at times use dividend discount models, but it's much more common to see analysts use cash flow forecasts, namely free cash flow. That is, if a company doesn't pay dividends, you could still estimate the cash that a firm is expected to throw off that is able to be paid out to investors if they so choose. And that's what free cash flow is, as you may recall. So those are the 3 examples of a dividend discount model valuation. The alternative to dividend discount models is called the multiples or comparables method of valuing stocks. So here's the example that I came up with to start us off. Let's say the house next door to yours is, well, think about all the different drivers that influence the value of real estate. The size of the house, the bedrooms, the bathrooms, the location, the distance from schools, trains, stores, how much land there is, and whatnot. And so let's say you take the house that's next door to yours, which means that the location is going to be about the same. So the key difference between the house next door to yours and yours is going to be maybe the size of the house. So let's say the house next door to yours is 3,000 square feet and sold last week for $400,000. Your house is 3,500 square feet. With no additional information, what's the estimated value for your house? So you can automatically see that, well, you just compare the size and yours is going to be 500 square feet more. And so you would bump up the value by maybe some amount that's linearly related to that. So if we wanted to wrap some math around this, what we might say is that, well, somebody paid $400,000 for 3,000 square feet. And if we work it out, that means that that's about $133 per square foot. And if we apply that to the size of your house, we get at least a back of the envelope estimation for the value of your home. Again, this is linear. It assumes that an increase or decrease is always going to be magnified or detracted by about $133 per square foot. Companies are valued this same way, except when you think about the value drivers for companies, we can think about things, what do investors pay for? They pay for future sales, earnings per share, assets, cash flow, and there are other items as well, but those are the ones that we see that's most common. So, for example, a PE ratio, what's that? Price per share divided by earnings per share. So it gives you an estimate for what somebody would pay for every dollar's worth of earnings. For energy companies, the average is about 20. So investors are willing to pay 20 times earnings to buy a share for, I don't know, Allegheny Power or Duke Energy or just an average company for the industry. The earnings per share for Southern companies, $2.34. So using industry information, what should the stock be selling for? So in this case, we take $2.34 earnings per share times a PE multiple for the industry of 20, and we arrive at, you can see in the math that if you take earnings times price earnings, you end up with an estimate for price. If we multiply these out, we get about $46.80. So you can see that in this particular example, the multiples method gives us a number that's not too far away from our discounted cash flow methodology. So that gives us maybe a little bit of confidence that we're in the ballpark. This is just sort of a basic introduction to the use of multiples or comparables to value companies. And you can see that it's elegant in its simplicity, but it also means that you're valuing a $40 billion company using a very, very simple method. It also assumes that, hey, the values for those peers or the industry is right, therefore the value for Southern Company is going to be right. Just as you might say, hey, if the house next door sold for $400,000 and you didn't think that it was worth that much, or you thought that that was too much, then your valuation might be off as well. But those are the different methodologies that are used to provide us with estimates for valuation. This is just to show you, this is a financial snapshot from Southern Company's webpage from June 2013. And this came from their investor relations area. So you can see that recent price is $44. high of 49, low of 42, so those are kind of all in the ballpark. We also have a beta estimated to be minus 0.01. That doesn't feel right to me, so we know that betas are estimated using data that compare how one company moves relative to the overall market. We're going to ignore that, and we're going to estimate betas ourselves coming up. Southern Company as a firm, all of their shares are worth $38 billion. That would be 870 million shares outstanding, selling for about $44 a piece. Gets us to that $38 billion. Here's the annual dividend of $2.03 per share. Because they have a payout ratio of 83%, it means that they have paid most of their earnings out in the form of dividends. We also have some information related to the financials of the company. And over here, here's our valuation multiples that we talked about. A PE ratio for Southern Company. Southern Company is currently selling for 18.8 times earnings. That's what you would have to pay. That also translates to roughly 2 times sales, 9 times cash flow. We have other information down here that we're not going to spend as much time talking about, but the company chose to provide that information. Okay, so that concludes our short introduction to valuing equities using dividend discount models and method of comparables or multiples. How this stuff plays in. Now we can start to get our arms around valuation. Dividend discount model or free cash flow models use time value of money where you forecast cash flow or dividends, and then you discount them back at the rate of return that investors require. And so we've learned about dividend discount models. We're now going to turn our attention to the weighted average cost of capital, because that ends up being the discount rate that investors use to pull back the cash flows that a company's supposed to throw off or forecasted to throw off to find out what it's worth today. So we're going to go through some examples. We're going to go through a personal finance example, and then we're going to go through a corporate finance example. Okay. All right, let's just keep going. So we talked a little bit about weighted average cost of capital and a little bit on the impact on valuation, but we haven't figured out how to actually do this yet. Let's take a personal finance example. Let's see, you have four different types of borrowing. You've got a mortgage for $200,000, and the interest rate on that mortgage is 7%. You've also got a car loan for $15,000 at 11%, credit card debt for $18,000, and a student loan at 9%, at a 9% rate. So you've got total debt on your balance sheet of $245,000. So this is the amount of financing that you are employing on your personal balance sheet. The question that I have is, what's the average interest rate that you're paying? Now, if we wanted to ballpark it, we would just take a simple average of these four. Simple average of these four is going to end up being 11.25%. But if you take a look at it, does that really represent the interest rate that you pay on average on your loans? No, because you only have $5,000 that you're being charged at 18%, and the very lowest interest rate that you're paying, you have the most amount of debt. So you wouldn't use an equal weighting to take that average. You would use a weighting that reflects the proportion of each of the loans that you're taking out. That's a weighted average cost of capital. So we have to estimate the weights for each of the loans. So the home mortgage is going to be the biggest. So 200,000 divided by 245, about 82% of your debt is constituted by the home mortgage. The car loan is only about 6%. Credit card is 2%. And then the student loan represents the remainder, which is about 10%. So the second step is to apply those weights to the interest rates. So 0.82 times 0.07, 0.06 times our 11% rate, a weight of 2% times the 18, and a 10% weight times an interest rate of 9. And now when we blend those together, this will take a minute. We end up with about 7.7%. So that is, in essence, your personal weighted average cost of capital, which you can see is very, very different from just taking a simple average, as you might suspect. So we need to do this for companies as well, because we want to understand the blend of the financing and what our investors are, in essence, charging us. Some companies are 100% equity financed. Some companies are 70 or 80% debt financed. Those tend to be the big bookends. Average company tends to be between 30 and 40% financed by debt, and between 60 and 70% financed by equity. There are other sources of financing, such as for companies, such as preferred stock, convertible bonds, and others, but the biggest two are debt and equity. And so what we need to do is we need to take a weighted average cost of capital for a company by essentially taking the proportion of financing that they use, debt, preferred stock, or common stock, and multiply that by the cost of each of those. What's the interest rate on the debt? What are my preferred stockholders charging me? And what are my common stockholders charging me? And then we add them all together. A few things. When we're estimating the weights, we see here on this example that we kind of understand that a mortgage is $200,000, the car loan is $15,000, the student loan is $25,000. But what about equity? Should we take the book value of equity, which represents the equity at the lower of cost or market, or the equity that was invested into the business originally, or should we take the market value of the equity? And the punchline is you want the market value of the equity as well as the market value of the debt, because that reflects the economics of the firm going forward. Sometimes it's tough to get the market value for debt because it doesn't trade every day. So we can either estimate that or we can substitute the book value. But if we have the market value for debt, we'll use it. The other thing that we want to recognize is that as a company, when we make, just like the mortgage debt, if we make interest payments as either a company or on a personal basis, that's tax deductible. So we have to adjust for that as well. So how do we calculate the cost for each of these? To calculate the cost of debt, estimate the yield to maturity on all the different sources of debt. To do that, remember, we solve for I on our financial calculator, given the bond's present value, future value, number of periods remaining to maturity, and the bond's coupon rate. That's what we use to estimate the yield to maturity. To estimate the cost of preferred stock, in other words, what are the preferred stockholders charging us by providing us with financing? Preferred stock is essentially a perpetuity. You buy a share of preferred stock on the open market, and let's say you pay $35 for that. And let's say the preferred stock pays you a dividend of $1.50. That's a perpetuity. So in order to find out what that is in terms of a rate of return, you just divide. Your investors expect $1.50 a year on $35 that they've invested, or an average rate of 4.3%. So to estimate the cost of debt, solve for the yield to maturity by computing I. To estimate the cost of preferred stock, take the preferred stock's dividends for the year and divide by the current price. How about the cost of common stock or the cost of equity? We've already seen at least one method for this. Capital asset pricing model. Risk-free rate plus beta times market risk premium. So for a Southern Company, if the risk-free rate is 3%, Southern Company has a beta 0.67. There's a market risk premium of 6%. The cost of equity for Southern Company is going to be about 7%. There are a couple other methods that can be employed to estimate the cost of common stock. One we've already seen in the case 2, if we take the dividend divided by R minus G and solve for the value, we have this formula. Well, why don't we just take the numbers and solve for R? We can rearrange. So for example, let's say the stock was selling for about $41, and I know next year's dividend is expected to be $2.07, I think we had. And let's erase that for a second. There we go. There it is. We have R minus the rate of growth of 2%, and we solve for R. We rearrange and solve for R. 41 R minus 0.02 equals 2.07. Follow that through. $41R minus 0.82 equals 2.07. And R is going to be about 7%. It's another way of estimating the cost of equity. Third method, let's say, for example, that we calculated the yield to maturity on Southern Company's bonds, and we got around 5%. So let's say we didn't believe the beta. Remember, the beta, as it's reported, was around 0 for Southern Company, and we don't believe that number. And so if we don't believe that number, we can't use this first method. And let's say we're not comfortable using that second method because we think that Southern Company is going to grow is not going to grow at a constant rate, so we don't want to use that second method there. And so what could we do? Well, one thing that we could do is we could say, hey, if you're a stock investor, You're last on the totem pole, so your required rate of return. So the stock is riskier for you than it is for all the other providers of financing. The other providers of financing, debt holders, are expecting 5%. Preferred stock is expecting between 4 and 5%. You're riskier, therefore, you would want to add some sort of premium to reflect the additional risk for you. So depending upon the situation, it might be 2%, or it might be 3%, or it might be 5%. In any event, it's yet a third method if you don't trust the other two. But our first choice is going to be to trust method one, the capital asset pricing model. So we've just come up with some methods for estimating the required rates of return on all of the component sources of capital for Southern Company. So let's say we have some additional information. Southern Company has a market cap of $38 billion. What does that mean? That's the market value of their equity. They have a market value of debt of about $24 billion. Where did I get that information from? I got that from Thomson Reuters through Yahoo Finance. The yield to maturity on Southern Company's debt averages 5%. Where did I come up with that? You can either look at the yield to maturity estimates in the footnotes of the company's financial statements, or you can look up yield to maturity estimates on finra.org. Many of them that I found there, I have to admit, were above 5%, but we're using 5% in this average. Effective tax rate is 35%. Where did I get that from? I looked at the company's income statement and just divided their taxes by earnings before taxes, just to give us a quick and dirty estimate. They actually have no preferred stock. They've got a very little bit amount of it, but we're not going to put it in this example because it's so small. It's less than a couple $100 million, so it wouldn't come into play. So let's do the weights first. We know that we have $24 billion in debt and we have $38 billion in equity. So what weights does that translate to? So that translates to a total of around, $62 billion for the whole company. So the debt would be $24 billion of that total. So 24 divided by 62 gets me to 39%. And equity, of course, is going to be the difference, 61%. And I can confirm that 38 divided by 62, yeah, about 61%. So how is Southern Company financed? With a shade under 40% debt and a shade over 60% equity. How about the component costs? On the previous slide, we saw that the yield to maturity on Southern Company's debt is about 5%. Cost of equity, 3% plus a beta of 0.67 times a market risk premium of 6%. That's what we did on the previous page. Gave us an estimate for cost of equity of around 7%. We also have a tax rate from above of 35%. So how do we put that all together? We take our debt percentage of 39 times our cost of debt, 5%. But we also have to recognize that that 5% is on a pre-tax basis. And we get a tax discount from the interest that we pay. So we have to multiply this number by 1 minus the tax rate in order to get the after-tax cost of debt. Cost of equity, take the weight of equity times the cost of equity. And this calculation gives us an estimate for Southern Company's weighted average cost of capital. So let's take a minute and do this calculation. And my first pass is is around 5.5%, if I did that right. So Southern Company's weighted average cost of capital, using the information that is on this slide deck, is around 5.5%. So what does that mean? That means that whenever Southern Company is considering spending resources on a new project, as a manager, Southern Company's managers take a look and determine that those resources cost us on average about 5.5% per year. Therefore, if we're considering a project, that project should earn a rate of return in excess of 5.5% per year in order for it to create value. There are some other applications for this having to do with valuation that we've seen previously in this slide deck, but that gives us kind of a quick and dirty estimate. So in this slide deck, what we did is we figured out a couple different methodologies to value common stock, and also went through an example of estimating a company's weighted average cost of capital. A few additional or final notes. In some treatments, you'll read about flotation costs. In other words, if we're going to issue new debt or issue new equity, then that should be considered. Well, flotation costs for larger companies tend to be less significant. We're going to ignore them for now. Short-term debt, should you include that? Well, if it's a permanent part of the company's financing, then it should be included in the weighted average cost of capital. In other words, if a company has 6-month loans, but they consistently have 6-month loans, that is, they just roll them over, then you should include that. Arithmetic versus geometric averages, specifically in estimating the market risk premium. The market risk premium, we know, is utilized in the estimation of a company's cost of equity. Risk-free rate plus beta times the market risk premium. The market risk premium is, in essence, what the typical stock would earn above and beyond the risk-free rate in a typical year. We usually use history as a guide, but if we do, we need to understand that there's different ways of calculating history. And you have arithmetic and geometric averages. We're going to use 6% unless we come up with a better one, at least for now. But suffice it to say, let me give you an example of arithmetic versus geometric average, okay? Let's say you have a portfolio that's worth $100 million, nice, huh, in year 0, and you give it to somebody to manage. 1 year from then, they double it. So the rate of return during that year is 100% that your portfolio manager earned for you. And let's say in the second year, it's cut in half. So the rate of return is minus 50%. So what rate of return on average did your portfolio manager earn for you? Well, the average rate of return, let's see, over 2 years, plus 100 minus 50 divided by the 2 years is going to give you an average of 25%. That's an arithmetic average. And an arithmetic average, you can see, may or may not be an appropriate estimate for what you actually earned. So your portfolio manager can tell you that they earned 25% per year. But if you take a look at it, you're actually you're not any better off than when you started. So a geometric average would, you take the ending value divided by the beginning value, 1 over n minus 1. So in this case, ending value is 100, beginning value is 100, 1 over the number of years minus 1, and you're going to get 0. And that might be, in this instance, a more accurate reflection of where you actually stand. You're not any better off than what you started. So there's different ways of taking averages. That's the punchline. This is really for finance and investment folks to fight about. We're going to use 6% for a market risk premium, and we'll talk about the arithmetic versus geometric thing another time.